Hello, everyone. My name is Minjae Koo. I'm a PhD candidate in accounting from University of Houston. I study financial archival, and in my job market paper, I study the implications of advisory fee structure for risk-taking and fair value overstatements of bond mutual funds. Mutual funds compensate advisors for managing their investments. They can compensate a base fee rate that is fixed regardless of the fund size. And this type of fee structure is referred to as the linear fee structure. Or they can compensate based on a fee rate decreasing with funds asset under management or funds AUM. And this type of fee structure is referred to as a concave fee structure. And these two types of fee structure are the focus of my paper. Prior studies show that linear fee structure induces a greater risk-taking behavior of advisors. Compared to concave fee structure, where the fee rate decreases, the fee rate does not decrease for the linear fee structure, inducing advisors with the linear fee structure to take greater risks and improve higher performance and increase higher asset under management. While prior studies focused on equity mutual funds, I focused on bond mutual funds. Compared to equity mutual funds, bond mutual funds are exposed to different types of risk, which are downside risk, liquidity risk, and redemption risk, which I'm going to explain in the later slides. But essentially, because of these risk features, advisors managing bond funds are more sensitive to the asset decline. They place more weight on the possibility of AUM decline than the equity fund advisors. Another feature of bond mutual funds is that bond prices are not readily available and ambiguous compared to equity prices because bonds are less liquid in the market. Using this pricing environment, bond fund advisors have more latitude in engaging in a discretionary fair valuation. Consequently, in this paper, I study how a linear fee structure induces greater risk-taking and fair value overstatements among bond mutual funds. I believe this question is important in terms of economic significance because bond mutual funds account for around half of equity mutual funds in terms of AUM size, and its AUM size has been steadily growing in recent decades, as you can see from this graph. Moreover, the risk and valuation feature of bond mutual funds are interesting and unique to explore. So the differences between equity and bond mutual funds can lead to different implications of advisory fee structure. The first key difference is the stakeholders' payoff expectation. For equity mutual funds, the upside potential is unlimited for equity holders. However, for bond mutual funds, the upside potential is quite bounded because bondholders receive a fixed principal and interest payments. So this nonlinear payoff structure of bonds can induce bondholders to be more sensitive to bad performance than good performance, as bad performance can actually increase the possibility of default and economic losses of bondholders. Another difference is liquidity risk exposure. While equities are generally liquid, bonds are less traded in the market. What's worse in the context of bond mutual funds is that investors can redeem shares at any point in time while the bond portfolio holdings still remain illiquid. So in the case of distress times, bond fund advisors may not be able to quickly redeem shares and pay back to investors for their investor and for redemption requests if they're not able to immediately sell their illiquid bonds. This can lead to a situation similar to a bank run. Lastly, they have differences in terms of flow characteristics. equity mutual fund flows are more sensitive to good performance than bad performance. However, bond mutual funds operate in an opposite direction according to recent literature, meaning that bond mutual fund investors sell more under bad performance than buy more under good performance. So these large redemptions following bad performance coupled with the illiquid nature of bonds can exacerbate the bank run-on state. So because bond fund advisors place more weight on the possibility of the downside risk, liquidity risk, and redemption risk, they place more weight on the possibility of AUM decline than the equity fund advisors. And it is not immediately clear how advisory fee structures plays a role in the risky aspects of bond mutual funds. So moving on to the hypothesis development, first I study the association between linear fee structure and risk-taking. So on one hand, like the equity mutual funds, I can expect that linear fee structure can induce advisors to take greater risk for better performance and higher asset under management. In order to do so, they will hold more bonds with high credit risk and liquidity risk and enjoy higher premium. On the other hand, advisors with linear fee structure have more sensitivity to AUM decline compared to concave fee structure. Because if you think about AUM decrease scenario, the fee rate remains fixed for the linear fee structure while it increases for the concave fee structure. So as the advisors with linear fee structure should be more sensitive to such AUM decline, they will hold more bonds with low credit risk to avoid deeper AUM decline. They will hold more liquid bonds to immediately sell and liquidate their positions to raise cash as a buffer in the case of financial distress. Moreover, Goldstein et al. 2017 find that bond fund investors are more sensitive to poorer performance than good performance in the context of bond mutual funds, and this tendency increases with liquidity risk. So if funds hold more liquid bonds, bond fund investors will be less concerned about the advisory ability to repay in the case of redemption, and they would have less reason to immediately redeem. So this will attenuate further AUM decline. Because my first hypothesis can be explained in both directions, it's set as a null form. A linear fee structure is not associated with the risk-taking behavior of bond mutual funds. Second, I study the association between linear fee structure and fair value overstatements. Like the risk-taking argument, I can expect the linear fee structure can induce advisors to overstate fair value of bond mutual funds because they have greater benefit, they get more benefit from doing so compared to advisors with concave fee structure. And unlike the risk-taking costs, which are downside risk, and because overstating the fair value of bonds does not involve a substantial costs, as long as it is within a reasonable estimate range, does not alert regulators and market participants, there is a clear association between linear fee structure and fair value overstatements. That is, under hypothesis 2, I argue that fair value estimates of bonds are more overstated for funds with a linear fee structure than for funds with a concave fee structure. Moving on to sample selection, I use 4 public sources, which are Form NPORT, Form NCEN, Form NSAR, and Form ADV. The 3 filings are from Bond Mutual Fund Filings Database, and Form ADV is from the Advisors Database. And then I also use 4 private sources, which are Radian Analytics, Trace, Municipal Securities Transaction Data, and Merchant Fixed Income Securities Data, which is also referred to as FISD, for the credit rating information. The period I use is from September 2019 and June 2021. Since the mutual funds are required to disclose NPORT and NCEN since September 2019, I start from this period. As for the linear fee structure measure, I use 3 proxies. WIR, which is the main measure, weighted incentive rate. This is constructed as a weighted average of these marginal fee rates divided by the first applicable fee rates, and 1 for the linear fee structure. CIR, which is also referred to as Cole's incentive rate, is commonly used, and it's a difference between last applicable fee rates and first applicable fee rates divided by the effective marginal fee rates, and set to 0 for linear fee structure. Linear is a dummy variable equal to 1 for linear fee structure and 0 otherwise. These 3 variables are common in the sense that a higher value indicates a more linear fee structure. As for risk and fair valuation measure, I show you the bond level definition. However, when I construct the risk or fair valuation measure for fund level regression, I construct by computing the weighted average of these bond level variables. So as for risk characteristics, I use 2 types of variables. The first is credit risk based on the credit rating. For higher credit ratings, such as AAA, AA, I use low credit risk. I assign low credit risk. Next, to capture liquidity risk, I use a ZTDR, which is a zero trading day ratio for a given year. So higher the zero trading day ratio, the higher the bond is likely to be exposed to liquidity risk. As for fair value overstatement measure, I use fair value difference or FV difference, which is commonly used in this line of research, which is difference between fair value estimates and the mode fair value estimates across funds that have the same bond, scaled by the par value. So this is the summarized statistics of important linear fee structure variables. And I find that I confirm that the distribution of these linear fee structures are comparable to those found in Massa and Pachauri that also examines the implications of advisory fee structure for risk-taking in the context of equity mutual funds. And also interestingly, more than half of bond funds adopt linear fee structure, while the less than half adopt concave fee structure, while both are commonly used. As for a preliminary analysis, I extend the line of research on the determinants of linear fee structures by considering 4 factors: economies of scale, monetary intensity, agency conflicts, and advisory ability. As this is not my main analysis, one thing I just want to point out in this result is that a linear fee structure is preferred for funds that desire higher AUM growth and greater risk-taking. However, my main results show the opposite, that advisors with a linear fee structure are less likely to take risks and avoid deeper AUM decline, as evidenced by this negative coefficients on WIR, CIR, and linear, when the dependent variables are credit risk and the TDR respectively. So this result is quite striking because it's contradictory. It's opposite to what Massa and Pachauri find in the context of equity funds. To deepen the understanding of conservative risk-taking behavior of linear fee advisors, I conduct several cross-sectional analyses. First, I test whether the fund importance to advisor have any effects on the conservative risk-taking behavior of advisors. I expect that larger funds, advisors managing larger funds, and solo advisors without any sub-advisors have a greater, stronger downside risk pressure as they have larger stakes with the fund and are less likely to take risks. And consistent with my expectation, I find that the coefficient on interaction term between WIR and large fund, or WIR and solo advisor, are all negative and statistically significant. Second, I explore whether the conservative risk-taking behavior of linear fee advisors are more pronounced for funds with higher, greater redemption risk. As a proxy for redemption risk, I consider 3 proxies. First is sufficient cash. Funds with sufficient cash would use cash as a liquidity buffer. And the second proxy is high redemption fees. Funds with high redemption fees would be exposed to less investor redemption because investors find it costlier to redeem when they have to pay. And the third proxy I use is open-end structure, which is the dummy variable when the fund is open-end structure, and 0 when the fund is closed-end fund structure. So compared to closed-end fund structure, which only allow investors to redeem after the lock-in period, open-end fund structure investors can always redeem in any occasion, meaning that these open-end structure investors in open-end funds are more exposed to greater redemption risks. And what I find here is that advisors with linear fee structure are even less likely to take risks when funds are exposed to greater liquidity risk and redemption risk, which is also in line with my first hypothesis. Next, I explore whether the conservative risk-taking behavior of linear fee advisors differ between periods of high and low market uncertainty. Because advisors with linear fee structures may be more conservative risk takers during periods of high market uncertainty, as funds are more exposed to downside and liquidity risk during this period. As a proxy for market uncertainty, I use pre and post period of peak phase of COVID-19, which is, as you remember, the February and March of 2020. And to assure that the risk variable does not affect the subsequent periods, being the risk that has been exposed prior to COVID-19 affects the subsequent periods, I use the change in risk variables for the dependent variables. In column 1, I show that the coefficient on the interaction term between WIR and pre-pandemic is positive and statistically significant. And in column 2, I find that the interaction between WIR and post-Federal Reserve bond purchase announcements is also positive and significant, suggesting that this conservative risk-taking behavior of linear fee advisors are attenuated during periods of lower market uncertainty. Next, I provide evidence on hypothesis 2. I find that advisors with linear fee structure are more likely to overstate the fair value of bonds, which is in support of hypothesis 2. Digging a level deeper, I partition the sample based on the type of funds and find that overstatements of linear fee advisors are more pronounced for long-term funds, municipal funds, emerging market funds, foreign funds, and lastly, I also look into index and exchange traded or ETF funds. Because these funds track market index, and market index are readily available to public, I expect that advisors managing these funds would have less incentive to engage in discretionary fair valuation. Moreover, ETF managers publish a list of holdings on a daily basis, which even limits ability to engage in discretionary fair valuation. So in line with this expectation, I find no evidence on the association between linear fee structure and fair value overstatements among these funds. Again, to deepen the understanding of fair value overstatements of linear fee advisors, I conduct several cross-sectional analysis. First, I test whether fund importance plays a role in overstatements. And I find that among large funds, the association between the WIR, linear fee structure, and fair value overstatements is more pronounced, suggesting that advisors with linear fee structure are even more likely to overstate the fair value of bonds for more important funds in terms of asset size. Second, I explore whether the fair value overstatements of linear fee advisors are more pronounced for funds with higher redemption risk. I expect that if funds are more exposed to greater redemption risk, advisors would have more incentive to fair value, overstate the fair value to attenuate immediate redemptions or immediate investor outflows. And in line with expectation, I find that advisors with linear fee structure are even more likely to overstate fair value of bonds when funds face higher redemption risk. Next, I find whether I test whether the fair value overstatements of linear fee structure advisors differ between periods of high and low market uncertainty using the same COVID pre and post COVID-19 period. Using the wider pricing dispersion environment during the high market uncertainty period, I expect that advisors would engage in a greater overstatements during these high market uncertainty periods. However, I fail to find evidence that this is so. Lastly, for the cross-sectional test, the SEC recently requires funds to disclose whether they have corrected any net asset value or NAV errors. Recent anecdotes also show that when funds engage in such NAV error corrections, it would lead to the reputation loss to investors. So in order to make up for such reputation loss, advisors would be more cautious in overstating the fair value and would be less likely to engage in such opportunistic behavior. And in line with my expectation, I find that the coefficient on the interaction between WIR and NAV error dummy is negative and significantly statistically significant, suggesting that advisors with linear fee structure are less likely to overstate the fair value of bonds when funds experience NAV error adjustments. As my final table, I match the focal funds with the pair funds with less linear fee structure within the same fund family or funds managed by the same advisor. And interestingly, I find that fair value estimates are more overstated for funds with more linear fee structure. To do a stricter test, I match the focal bonds with the same bonds of the different fund within the same family. And I find that the fair value difference is even greater for bonds managed by funds with a more linear fee structure, which reinforces my argument that the linear fee structure induces higher, greater fair value overstatements. So in sum, while I find that linear fee structure is designed to induce greater asset growth or AUM growth, I find the opposite, that advisors with linear fee structure take less risks. Instead, they're more likely to overstate the fair value of bond positions. My finding points out to the possibility that the linear fee structure induces an undesirable advisory conduct from fund shareholders' perspectives. Moreover, my findings suggest that when designing an incentive contract, one should attenuate agents in other incentives and opportunities that can hinder the effectiveness of contracts. To provide the remedy for misalignment between incentive structure and risk-taking, redemption restrictions such as swing pricing policies or higher redemption fees can attenuate the incentive to avoid downside risk. And also to provide a remedy for fair value overstatements, one can consider stricter requirements on sources and methods of fair valuation, which can possibly attenuate opportunistic reporting decisions of these asset managers. Thank you very much.